In this presentation, we will work a problem related to a forecasted departmental income statement. The scenario will be that we currently have two departments. We're thinking about adding another department P. We're going to make an income statement, a forecasted or budgeted or future income statement with department P for managerial decision making. We're going to have the information up top. We're going to use that information in order to fill out our income statement down below. We're going to start off with our prior year number. So here's our prior year income statement when we only had the two departments, C and M. So here's our two departments, C and M. Here's the total. Here's the sales, the cost of goods sold, our normal type of income statement setup, and a normal type of income statement format. Then we have the plan for the new department. That's going to be Department P. Department P, we believe, is going to have sales of $53,000, gross profit margin 65%, salaries of $8,500, advertising $1,000, store supplies of $400, and equipment depreciation of $700. P will replace space currently used by the other department. So in other words, the new department is going to take some of the occupancy space from the other departments. 20% from the current department C will now be going to the new department P. 25% from the current department M will be now going to the new department P if we do implement this process. And then we have the office department expenses allocated in proportion to sales. So the office department expenses are allocated in proportion to the sales. And then, so when we allocate between the departments, they're going to be allocated in a ratio kind of analysis similar in proportion to sales. Office department expenses, expected increase of $7,200. So we think there's going to be an increase from the prior year as we budget or forecast forward $7,200. We think there's going to be an increase in sales for C and M of 8%. So sales is going to increase by that 8%. Store supplies increase in proportion to the sales. So we think the supplies for the store will increase with proportion to the sales. Okay, so given that information, we're going to go into our forecasted income statement. We're going to start with sales, and we're going to say, all right, sales. For C, we think that sales is going to increase by that 8%. So of course, if we take the prior time sales, which was the 170,000 times 0.08 or 8% plus the 170,000, that's going to be 183.6. Better way to get there or faster way to get there is 170,000 times 1.08, which is 180% or 108%, 1.08, and give us directly there. So that's what we'll do first. We're going to say in cell B39, we'll do this with a formula, use formulas as much as possible. We're going to say that it's going to take that prior year number times, I'm hitting the up arrow to go up from this cell that we started at, and we want that 8% times the 8%. And to get it to be 1.8%, what we're going to have to do is basically bracket this and say we want 1 plus that 8%. In other words, we'd have to hard code the number. So we want 1 or 100% plus 8%, which of course is 108% times the sales number. That gives us that 183.6. So again, here's the formula. And then we'll do the same thing for M. We're going to say M equals, we'll go back up top, the 115. I'm going to scroll back down so we could see it. And then say plus brackets 1. We have to have the brackets around it because it's going to be order of operations. We're going to have to do this addition before the multiplication, which should be this item. So C3 times 1 plus 8%. So in other words, it's taking the sales times 108%. And that gives us the 124,200. And then P was straightforward in our data. We think it's going to be this is the new department, 53,000. So total sales then is going to be the sum of the 183.6, the 124.2, and the 53, or the 360,800. Then we're going to have the cost of goods sold. Now the cost of goods sold should change in proportion to the sales, you would think, because we're going to have the same gross profit margin. So it too, you would think, would increase by 8%. So even though we have 8% increase in sales, given the fact that the profit margin is usually the same, cost of goods sold, you would expect to go up the same rate. So that's what the assumption will be. So we'll do the same thing. We'll say equals, here's that 83.3 for cost of goods sold, times, and then I'm going to scroll down so we can see it. Same thing, brackets, 1 plus the 8%, brackets, and enter. We'll do the same for M. M equals, scrolling up, the 71.3 times, scrolling back down, brackets, 1 plus, and then we're going to pick up this 8%, brackets, enter. Now for P, we said that there was a gross profit margin of 65%. Now remember what the gross profit margin is. It's going to be the gross profit. Let's scroll up top so we think about it. It's going to be the gross profit divided by the sales. Not in this numbers because we're not using the same numbers, but here, gross profit divided by sales. And now we're trying to figure out what the cost of goods sold is, and the cost of sales minus cost of goods sold is gross profit. So what we need then to do, if you need to work this out in the algebra, then you write down the algebra to figure this out. You would say gross profit margin equals the gross profit divided by the sales, and then we need to basically then figure out how we can use that number to figure out the cost of goods sold, which is sales minus cost of goods sold. Now, to do that, we'll do that with a formula down here. We're going to say this equals, and we're going to pick up the sales, and we're going to say 1 minus the gross profit, which was 65%, and brackets, and it didn't like that, times 1 minus the gross profit. So there we have it. And you can think about that. Obviously, if the sales is going to be 65%, so we're going to say, the gross profit is 65% of sales. So if we had the 53,000 times 0.65, that's going to be the 34,450. And that means that 1 minus 0.65, 0.35 must be cost of goods sold times the 53,000. So that's, there's a couple different ways you could figure that out, but notice if just work the algebra with this formulas, the formula sales minus cost of goods sold equals gross profit, and gross profit is percent, is the gross profit divided by sales. Okay, so then we're going to sum this up, equals the sum of these items. That's the 185,518, and then we have the gross profit. So gross profit, we will subtract these out then. This equals the 183,600 minus the 89,964. And then I'm going to copy that across using autofill. I'm going to put our cursor on that little box and then autofill it across. Auto drives it over. Dr. Phil does the calculation. Autofill. And I missed one box though, so let's drag it over one more time to get to the total. Obviously these two add up to 175,282, that number. And then we're going to have the direct expenses. So we'll say the direct expenses are next. I'm going to put a subtotal direct expenses with a colon. First item, I'm going to say equals and scroll back up, and we're going to pick up the salaries. So the salaries item. Now we're going to assume that the salaries are not changing because they're salaries. They're going to remain the same. So I'm going to say this equals, and I'm going to scroll back up and say that the salary is the 20,000 for C, equals, and scroll back up, and the salaries is going to be 8,007 for M, and then equals, and scroll back up to our new data where we have salaries of 8,500, and enter, and then we'll sum that up, equals the sum of C, M, and P. That gives us the 37,200. So the next item is advertising. So I'm going to say equals, scroll back up. We're picking up the advertising now, and enter. And again, we're going to say there's no change on the advertising budget. So we're going to say this equals, scroll back up and pick up the advertising 1,400 tab, and then equals, and scroll back up. We're going to pick up the 200 tab, and then equals for the new department P, we have advertising of 1,000 is what we're budgeted for. Then we'll sum that up, equals the sum of 1,000 for 200 and 1,000. That's going to be the 2,600. Then we're going to go to the store supplies. So we'll say equals here and scroll up. We want to pick up the store supplies and enter. Now the store supplies increased in proportion to sales. So we have the same increase, in essence, the 8%. So it's going to increase by that 8%. So we're going to say this equals, same kind of calculation we did up top, the prior store supplies times, scrolling back down so you can see it, brackets 1 plus, then picking up this 8%, brackets, and enter. So there's the 1026. We'll do the same for M equals, scrolling back up to the store supplies. Store supplies, here's the 400. We're going to say times, brackets, and here's so you can see it. I scroll back down, 1 plus 8%. So again, it's basically the store supplies last year times 8% plus the store supplies last year, or store supplies last year times 108%, or 1.08. And that gives us the 432. Store supplies for P is going to be equal to the 400 in our data set for the new department. Tab, summing that up equals the sum of the 1026, the 432, and the 400, 1858. Note that there could be rounding here on a couple of these numbers. That's okay. It's a forecast, so we don't expect it to be perfect. And then we're going to have the depreciation. So we'll say this equals, scrolling back up, depreciation, tab, and this equals, scrolling back up, the same number for the depreciation will be the same. We're going to assume it's straight line here, equals, and we're going to scroll back up, and we'll pick up the 500, and then depreciation in the new department is going to equal, and we'll find the new department depreciation, which is 700 in our new data set. Summing these up equals the sum of 1,007, 500, and 700, or 2,900. Then we're going to total that up, giving total direct expenses equals the sum of the 20,000, 1,004, the 1,026, the 1,007, 24, 126, selecting that, highlighting across, giving us the totals all the way across. Now we're going to have the expenses that we're going to need to allocate. So first we're going to have the rent. So the rent expense, going to scroll back up. Here's the rent. Now, of course, if we have a new department, we said that we're going to have to allocate differently. We got the rent on the whole place. The new department's going to be taking up 20% of what C had last time and 25% of what M had last time. So we're going to have to figure some type of allocation based on that. We're going to do that with our little worksheet down below. So we're going to say, hey, let's start with the prior year's rent. Here's what we had last year. For C, scrolling back up, the rent allocated to C last year was 7,120. Tab. The rent allocated to M last year, scrolling back up, was, where did it go? 4,080. And now we don't know, P of course was 0 last year because there was no P. So we're going to sum that up then, summing up this column. And then we're going to pick up 1/5 from C to P. So this is where we started from. But now we're going to say 1/5 of this amount that we allocated to C last time, because 1/5 less is going to be going to P. So I'm just going to say, hey, well, that's what we gave to him last time. If I divide it by 5, then we're gonna say, or let's just take it out. This equals, and I'm going to make it a negative. Negative this times, or divided by 5. Divided by 5. I kind of butchered that. So it equals this negative divided by 5. Why negative? Because I just want to flip the sign to show it's going to be a subtracted here. So we're going to take it out there, and we're going to put it in here. So P is going to be negative of this number. So this is divided by 5, and we're just going to take it out here and put it back into P. So that would make sense because P is taking 1/5 of the rent from M, and then we're going to take 1/4 from M to P. So we're going to do the same thing for M now. We're going to say, all right, I'm going to say negative instead of equals. The 4,080 divided by 4. We're going to take 1/4 of it, and we're going to apply that to P, which I'm going to say negative of this number. So the total will remain the same. In other words, if I sum this up this way, C, M, and P, and I sum this up this way, C, M, and P, no change. Rent remained the same. In total, we're just going to take 1/5 from what we allocated to C last time, allocated to P, 1/4 than what was allocated to M last time, allocated to P, and that's going to be it. So now we're going to have the current year rent. So current year rent is going to be, say, the sum of these items, and then I can copy that across. I'm just going to say copy this across and one more over. And then of course if we sum these up, 11,200, it sums up that way as well. Now if we want to see this on a percentage of total basis, the percentage of the total is now going to be equal to 5696 divided by 11,200. This equals the 3,060 divided by 11,200. This equals the 2,444 divided by the 11,200. And if we were to sum that up, then it should add up to 100. So that's going to be the rent that we're going to allocate. So we'll allocate the rent based on that. We're going to say, all right, back up to our schedule over here, C, P, and M, line item rent. It's going to be allocated according to the schedule. C gets 5,696. M is going to get 3,060. P is going to get allocated 2,444. Summing that up equals the sum of these three items. 11,200 is the rent. Now we're going to have the utilities. So equals the utilities is the next line item we're going to have to allocate out. So if we scroll back up, we're going to say the utilities are going to be allocated in proportion to the rent. So if we scroll back down, we're going to say, all right, the rent we allocated here, and we found these percentages based on the rent. We're going to allocate the utilities based on those percentages. So we'll go back up top, and we're going to say this equals, and we're going to scroll back up to the utilities for the last time period. So utilities up top, we're going to take the total and then allocate it based on those percentages. So the 4,300 times, and then scrolling back down, we're picking up this percentage for C. And then tab, so let's do this again. We're going to say this equals, we're on the utilities for M. We're going to pick up the total utilities, 4,300 times, and then scroll back down to the percentage for M, which is the 2732. Tab, and then we're going to say this equals and pick up that same utilities number again. So we're going to say utilities 4,300 times, scroll back down, and we're going to pick up the 2182 tab. And then we'll go ahead and sum this up. So we'll say equals the sum of these three items and enter. So that's going to be the 4,300 that we'll allocate in accordance with those ratios. Okay, so the next item is going to be the share of office department expenses. So we're going to say equals, scroll back up, and we're looking for the office department expenses. So the share of office department expenses, and if we scroll back up, we see that the office department expenses allocated in proportion to sales, and the also office department expenses increased by 7,200. So we're going to scroll back down and we're going to go through our worksheet for the office department expenses. I would start off with current year sales so that we can get a proportion to sales relationship. So now we've already worked out what sales will be for the projected sales. So we're going to say this equals the sales in our forecast of 183.6 tab. For M, we think the sales are going to be 124.2 tab. For P, we believe the sales will be 53,000 tab, or a total of some of these items, 360,800. Now we're going to take the percent of sales. So the percent of sales will equal the 183,600 for C divided by the total. So we have this percent allocation. This is very common, used all the time, not just in accounting, just anytime we need to measure something, we often use this kind of ratio analysis. This equals the 124,200 divided by the 360,800. This equals the 53,000 divided by the 360,800. And if we sum these up then, that should add up to 100. So now we've got our breakout that we can use, adding up to 100, so that we can break out some type of expenses, whatever expenses that we need to break out. So now we're going to take the current year expenses. So we need to figure out what the total current year expenses will be, so that we can break them out in accordance with these percentages. So to do that, I want to take the prior year expense, and I'm going to start at the total this time, because I don't know what the breakout is. I'm going to start at the total, then break it out, which can be a little bit tricky to think about because we're used to working from left to right. But we're going to start with the total. I'm going to say this equals, and scroll back up, and we're looking for the total for the utilities. So I'm just going to pick up the total amount, which is the 4,000, the share of office department expenses, which is 16,000. So 16,000 and enter. And then we have the projected increase. And the projected increase was given in our data. So I'm going to say this equals and scroll back up. And that was the projected increase 7,200 and enter. And then if we add those up, then we're going to say this equals the sum of the 16,000 and the 7,200, or the 23,200. Now we want to break this amount out in accordance with these percentages. So we're going to say this will be the total current year expenses. This is going to equal the 23,200 times the 50.9% tab. This for M is going to equal the 23,200 times the 34.4% tab. This is going to equal the 23,200 times the 14,700 tab. And then of course if we add these up, it'll add up to the 23,200. Now we'll scroll up and add this data into our worksheet. So we're in C for share of office department expenses in cell B53 equals, scroll back down, we're going to pick up that 11,806 tab. Then we're going to be in for M in line or cell C51 equals, scroll back down, we want that 7,986 tab. And then for P, we're going to say this equals, scroll back down, and we want that 3,408 tab. And then we're going to sum this up, equals the sum of those three numbers, and enter. That'll give us the total allocated expenses. We're going to sum those up now, equals the sum of these three numbers, enter. So that gives us the 19,689. We're going to highlight that across. So there's going to be those numbers, and then we're going to have the total expenses then. Total expenses being equal to the total direct expenses plus the allocated expenses. That's going to be the 43,815. I'm going to highlight that and autofill that across. So there we have those numbers, and then we've got the net income. So we're going to have the net income, and that'll be equal to, we'll pick up the gross profit minus the total expenses and enter. And then we'll go ahead and copy that across. We'll select that item and copy it across. And then so the bottom line is this 9224. So that's your first kind of check number. Then you probably want to go back and just double check any other number. If that's off, obviously you want to go back and check the other numbers. That's probably the first number to check.